When a CFO begins a new role, whether permanent, interim, or fractional, it's important to have a clear and organized plan in place to make a meaningful impact quickly. The first 30 days, often called the assessment phase, focus on understanding the business deeply, building relationships, and reviewing the financial health. This includes looking closely at the strategic and business plans, the overall business model, and the competitive environment. At the same time, the CFO should review the latest financial information, such as board packs, management accounts, forecasts, budgets, cash flow, and capital structure. Engaging with stakeholders is key during this time, meeting with the CEO, management team, board members, finance team, department heads, investors, and lenders helps identify their priorities and areas that need improvement. Lastly, it's essential to evaluate the finance team itself, understanding their skills, roles, and any gaps that might exist, so the team is positioned to support the company's goals effectively. This thorough assessment lays a solid foundation for the CFO to add value and align actions with the organization's priorities. Start by reviewing the company's internal controls, regulatory compliance including reporting, taxation, and filings, as well as the status of audits by checking the latest audit opinion or when the next audits are due. From this initial assessment, you can summarize the business's financial health, begin building relationships with key stakeholders, and evaluate the capabilities of the finance team. Moving into days 31 to 60, the focus shifts to aligning finance strategy with business goals, refining forecasting models, defining key performance indicators, and identifying inefficiencies in processes like reporting and budgeting. It's also important to evaluate the accounting and ERP systems to find automation opportunities and strengthen governance by improving internal controls and reporting practices. By the end of this phase, you should have a strategic finance plan ready, updated forecasts and KPIs, and a process improvement plan underway. Then, from days 61 to 90, the emphasis is on executing the strategies developed earlier, influencing decision-making, and embedding financial discipline throughout the company. This includes engaging with the board by presenting the initial strategic finance plan and highlighting early wins with a timeline for future updates. Additionally, focus on developing the finance team by improving their skills through mentoring and training, and begin recruiting to fill any critical gaps. It's important to prepare forecasts that cover both potential growth and downside scenarios to help the organization plan effectively for different outcomes. Strengthening communication and reporting with investors and lenders is also key, ensuring transparency and meeting any reporting requirements they have. On the strategic finance side, leading or supporting activities like mergers and acquisitions, fundraising, restructuring, and initiatives to improve profitability will drive value. After the initial strategy and alignment phase, you'll be equipped to develop a board-level finance strategy, conduct thorough scenario planning, and provide timely investor updates. Overall, this 90-day plan creates a solid foundation for any new CFO role, whether permanent, interim, or fractional, helping you to organize your priorities and make an impact quickly. Once the first 90 days are completed, it's essential to revisit the plan regularly and adjust as needed to keep meeting the ongoing objectives of the CFO role in day-to-day operations.